Guys, what's the market? Sounds like a very easy question for when you're looking at the screens and you're saying, well, what's the market? And the guy on the screen here is on the telephone, and that's probably the question he's being asked. What's the market? The guy looks up at the big board and he says it's 45 bid, 50 offered. That's not really what the guy's asking, because the conversation develops a little bit here. If you'd seen the video that maybe Kim had linked into anybody that received the invite for today, the question was, the guy was working orders, basically. This is not a trader in the true sense of the word, a guy that makes decisions. This is a guy that fills orders. He's on the back desk, he's picking up the phone. It could be to somebody upstairs in his own bank, his own organization. It could be direct to a client, a big commercial client, perhaps. It could be to a fund. And what's happening is an order's being phoned in. The trader on that desk, and it might be a treasurer who wants to hedge out an exposure that perhaps a business has, and they have direct access perhaps to this desk or through a third party. And this third party's phoning up, or this direct access is phoning up and saying, what's the market? Now, this is really, really, really important, because when we start in the retail space, we start talking to retail traders, when we start asking them questions like this, what's the market? The first thing is, they don't have a clue what we're talking about. What do you mean, what's the market? And then the next thing they'll do is they'll quote the inside market. They'll quote the bid offer spread. The commercial on the other end of the phone isn't really wanting to know that. What they're really wanting to know, and this is where we develop out this storyline, is what's the actual market? They want to get some feedback from this guy. Okay, they've maybe got 500 contracts they need to fill. They're wanting to buy, and this guy's going to try and get them the best possible price. And the guy stays on this phone until the fill perhaps is done, or he gives them a little bit of wiggle room to play with this. So when he asks, what's the market? The guy's saying, look, you want to buy 500? We're working some prices here. I think we could wait for a little bit of time. I think we could do a little bit better for you. I think we might get you an extra couple of points. So here's the point that we're going to develop as intern to pro exercises. And we're going to be working on some of this question today as an exercise. So it's not just a sales webinar. It'll be an exercise where you can actually, learn, hopefully learn something that maybe looking back at it should have been straightforward and should have been very obvious, but perhaps when you first approach this question is a lot less obvious. I think one of the key aspects to this question is this. Number one, do you know how to price the market? Number two, do you think the ability to price the market accurately is important? Three, do you think you've got the tools necessary to price the market accurately? If you've answered yes to that it's important, then of course you need to have the tools to enable you to do that. In the very first webinar we did a few weeks ago, we talked about a car auction. Can't remember what the car was. It was a Ford something or other. And we asked, what was important to know before you stepped into that auction? And just about everybody responded that the current price of that car would be quite useful to know. In other words, a fair value wholesale price or a fair value retail price would be useful to know before you step into the auction. Now, this is all very, very good if you're going to be going into the auction and your idea is to flip the car and your idea is to make sure you buy below fair value so that you've at least got a chance of making money. If you don't have that knowledge as a trader, what makes you think that you're going to be successful today? What makes you believe you're going to be successful? Now, it might be a setup. And this is something we've talked a lot about this week. There's a lot of good setups out there. Some of you may have came from Hubert's group. And Hubert's gives a lot of great setups where you can look at a particular setup and say, there's a setup. This is where you're going to be buying this. This is where you're going to be selling this. The question I've got on that type of information is, does that make you a trader or does it make you an order filler? In other words, the definition of the word trader is where we want to focus on. Because trader, in what we're going to be defining trader as, is the professional, the person who makes the decision to buy or sell. Well, if you use an automated setup, or if you use a setup that we can show you, that Hubert can show you, or anybody else can show you, some of which will be terrible, some of which will be brilliant, some of which will have a very, very nice positive expectancy, and some won't. Well, if you do those trades religiously and they've got a positive expectancy, it'll be profitable. We'll show you a trade from Friday. In fact, that should you have just have done the trade itself, and depending upon your exit strategy, you could have made $10,000 on basically a one lot with a one add-in, $10,000 on the NASDAQ on Friday. Now, Friday would not have been that difficult because it was almost, as you probably well know, a straight line drop on Friday, and therefore a very religious setup, a very religious structure, a very, very automated type setup or a systematic setup would have done very well on Friday. Obviously, that's going to be difficult, though, because it's not always as good as that. So therefore, when it's not always as good as that, what do you fall back on? Do you just take the losses on the chin when it chops backwards and forwards every now and then? Or do you want to learn a little bit more so that you can interact with this process, so that you can improve on the process, so you can become part of the process going forward? In other words, we can give you a signal. And the signal says sell, and sell at this price. And we'll show you that sell today. We'll show you the sell from Friday. And you sell at that price. But what decision did you make to sell at that price? That was it. Did you have a reason why you might not want to on this occasion? Did you have a reason why you might want to interact? Now, for some people, of course, that's what they want to use this type of service for, this type of signaling service, this process, this setup for, because they don't believe they're ready to interact yet with themselves. They don't believe they're good enough. They don't believe they're consistently enough. So therefore, they're looking for something else to help them. We call that the intern process. The intern process is when you're basically filling an order for somebody else or something else. And that something else is a setup. In most cases, that setup, for most setups, most cases, they're going to be things like volatility expansion type setups or volatility contraction setups. A volatility expansion setup, for example, is a break of a key level, and therefore you're going to buy it if it goes above this key level, and then there's going to be a break of a key level, you're going to sell it if it goes below the key level. In other words, you're basically filling the order of the setup. You're not interacting with the order, because why would you if you don't know anything else? Why would you interact with the order? Because it's got a positive expectancy is the usual answer, and you're absolutely right. The point is, on the odd occasion where that setup is quite clearly not going to work, would it not be a good idea to just not do the trade? And if you find that you're not doing the trade and it still has a really good positive expectancy, maybe there's something you need to learn that's beyond what you're seeing already. So as we develop, this idea of following the setups is what we call the intern process. When you start with the bank, you're on the phone. You're basically taking a phone call like this chap here. I'm not saying he's an intern. He doesn't look like an intern, but you're taking the phone call. And you're obviously now passing that phone call to a filling trader, filling broker on the floor. So they'll go away and they will get the order filled. They'll come back with a fill and the fill will be relayed. They don't have to decide. In fact, I think he mentions in the video, his job is not to think. His job is just to get it done. Simple as that. So in other words, when you do a setup, what's your job? Hubert gives you a setup. We give you a setup. Somebody else gives you a setup. What is your job? Your job is to get the setup done as fast and as aggressive and as clean as possible at exactly the right time without making mistakes. Well, that's the intern's job, isn't it? They don't have to worry about it. It's got a positive expectancy, and if it doesn't make any money on this occasion, so what? It doesn't make any money on this occasion. It's a positive expectancy. It's a probability. It's not a certainty. So this is the intern's process. And what we learn through the intern's process is to just get our execution better. Because what happens after the intern's process? We become intermediates. And what does the intermediate do? They start working the price for this client who's on the phone. So in other words, let's just think about this guy here. What's the market is the question. Well, what is the market? Well, let's take a look at a very, very, very simple chart. You can see that one single candlestick. You can see a series of prices between 60 and 70. And this guy's on the phone and he's saying, what's the market? Well, the answer might be, as an intern, the answer is 70 traded. 70 was the last traded price, right? That doesn't mean that's what the bid and the offer is just now. The bid and the offer might be 69 bid, 71 offered. It might be 69 bid, 70 offered, okay? So as an intern, step one is simply to say 69 bid, 70 offered. Now, if you're an intern and you've got a buy trigger for whatever reason, whether it's a setup because of a time of a day, whether it's a setup because of a structure of some description, and the setup, for example, is a buy trade, and the buy trade suggests that you've got to buy at 71, well, you're now ready as an intern with a buy stop order at 71. Let's assume that this trade could go either direction, and you could say, right, your trade is to buy at 71 or 59 for a sell order. So that's your intern's trade. Your intern's trade is to buy above or sell below whatever the setup is, and we're not discussing what the setup here is. What we're discussing here is that that's your job as an intern, step number one. So it's nothing to do with this candle, is it? The candle itself is almost irrelevant because you're leaning on the setup. You're leaning on the commercial entity or the structure or the rule-based system that you're asking and you're aware of is making a positive expectancy. Otherwise, I don't know why you'd be using it in the first place. Of course, it must be making a positive expectancy. So the trade here is the intern step one, is to buy 71s and sell 59. Now, if the setup is to fade this market, you might say, right, I'm going to fade 69, and I'm going to, obviously, that's the only trade you can do because it is only one fade opportunity. So the fade is going to be to fade 69. If the price goes higher, then that's the end of the trade. There is no setup. So there's a volatility contraction trade. So step one is doing the order that the setup tells you to do. That's it. That's the end of the story. And obviously, it's all about now developing your execution. So step number two, as an intern to intermediate, is to now start thinking a little bit more about how you're going to develop out this question. In other words, you're being told to buy at 71. You're being told to sell at 71. It doesn't make any difference now at this stage. The intermediate stage is to now think about what the market is. So let me ask you a question based on this. What is the market? Okay, so I want to now take you off this idea of just simply filling an order for somebody. What they're now asking you to now do is quote me a two-way price. Okay, so you're now developing beyond an order filler. What I'm now asking you to do is quote me a two-way price on this order. There's enough information on that screen for you to quote me a two-way price. So what would your two-way price be on this order? I want a bid price and I want an offer price. I want to see if you've got the ability to move into the intermediate step. I want a bid price and I want an offer price. Because as a market maker, that's exactly what you're going to be doing the first day you're on the floor. You've opened up at 60. Your first day on the floor as a market maker, as a local. and the price is going 60s to 70s, and you're about to step into the market. So what are you thinking about what you fancy bidding and offering? There's got to be an answer. There's got to be a way of solving this very simple question. Well, in gut sense, you would probably look at it and say, well, first things first, it's in an up move. There's been buyers at the open, and we've moved 10 points higher. So I'm already looking at a market that seems to be bullish. There's no other information available for me to use, so it's a very, very simple, straightforward situation. My feeling now is that I should be offering what price? Type in a price. What price would you offer if you're now looking at bidding and offering two-way price? In other words, you get a phone call and somebody says, what's the market on this product? What's the market on product X? What they're now asking you for is, what are you willing to bid and what are you willing to offer? They want a two-way price. As a market maker, you've got to be able to provide this two-way price. What is it? What's your two-way price? If you don't know, you're already in need of a lot of help to get to this point, because this is us just moving into day one on the floor. If you don't know what price you want to bid for this or offer for this, how are you supposed to step into any market? Because this is all we really need to start with to understand whether we're on the ball, whether we're in the game, whether we're contemplating the proper pricing of a market. And it comes back, I suppose, round to the original question is, A, is this important? Well, if you don't know what price as a market maker you're willing to bid or offer for this, how can you possibly as a trader expect to make money if you don't know what the market makers should be bidding and offering? In other words, how do you know what fair value is? So there's got to be a formula that a market maker would start thinking about and using to figure out what they would bid and offer for this product. So let's think about it. Do the sums. I want you to give me a two-way price, and I want you to give me a bid price and an offer price. And if you can't do it, you can see where perhaps an awful lot of the need is. And this is just step one. Well, it should be pretty obvious at this stage, hopefully, that there is a very, very easy solution to this. And that is that you'd probably want to currently, remember this is the current price is 70. If I was on, looking at this as a trader's point of view, I would offer 80. I would offer 80, okay? And I would obviously look to bid perhaps 68s. Now, can you see why we did that? Why would I offer 80 and bid 68? Well, because we can see what the volatility is. The volatility at the moment is 10 points wide. So I would imagine within the next candle or two, whatever the time frame of this candle is, the pace of the move, I would suggest that the next price will probably be driving towards 80. It seems to be relatively obvious that that would be what's going to happen next. Now, when you first step onto the floor and you're asked this question, an awful lot of people will say, well, I'm going to put my offer at 100 and I'm going to put my bid at 50. And that's obviously these kind of guys that just hide from price. They're uninterested in doing any business. They haven't got a clue what they're doing. So they hide from price, but they still feel as if they're in the auction because they've at least made a bid and an offer. It's not good enough because they'll never do any business. In other words, if you've came back and says, I'm going to bid 60 and I'm going to offer 80, fair enough. Personally, I think you're probably hiding a bit from price there. But can you start to recognize the keys to how this works? Do you already start to recognize a little breakthrough in your own thought process about how this should evolve? Now, this is only step one, of course. This is using nothing but simply a single candle with no other information. And on the basis that that's all the information I have available, this is what my bid and offer would be. So let me draw a second candle. You can see, obviously, from your own thoughts and your own processes, whether you're going to get filled or whether you're not going to get filled. And we'll carry on the next candle. Okay, the price is now opened at 70. The price is now dropped to here. And I come back on the phone and I ask you to make me a two-way price. I asked you to make me a two-way price. Obviously, I've just been filled, because the price is now traded through my bid price. So I've now got a long position, perhaps at 68. So I'm now asking you, make me a two-way price again. Make me a two-way price. Again, if you're struggling with this exercise, well, you can see where you're probably struggling with your charts. You should be able to make a price on this candle without any trouble at all. Now, obviously, we're not just now looking at one candle. We also have information in the background to this candle as well. You're already starting to, I would hope, you're already starting to think about things that you'd love to know. What are the kind of things you'd love to know about this? How many sellers are in here? How many buyers were in the first candle? What's the total volumes? What is the current delta on this candle? What kind of value is developing in the background? What kind of time of the day is this? Is there any news coming out? Do you see how you're starting to now ask the right questions because you feel like there's a little bit of a limitation on your ability to quote this, but you should still be able to quote this. It's just a candle. Because there is a mathematics, there is a simple arithmetic behind this as a process. Now, if you ask me what I'm going to quote for this, I'll give you my quote. And this is just basic market maker maths. My quote in this is 60 bid. Okay, I'm going to go 60 bid and I'm going to 75 offered. $60 bid, 75 offered. Does everybody see why? I'm using the volatility on the upside and the volatility in the downside to price my market properly. The volatility in the upside was 10 points. So when it's at 65, I'm going to price my offer at 75. The volatility to the downside was 5 points. So I'm going to price my bid at 60. Bearing in mind I'm long at 68 at the present moment as a trader. So everything's still looking the same, right? Everything still looks pretty good. You can see obviously that when this candle closes, I've pulled away my bids because I don't know how far it's going to drop. I've no way of knowing, but I'm still concerned about the volatility in the background. Still concerned. So we can actually start recognizing that this is a very simple market maker math that we can bring to the party, and it's real. It's something that's tangible. It's something that we can look at and say, well, you know what? It's a realistic way of being able to start contemplating perhaps some of the market elements that seem, well, reasonable. Now, when we look at it, you might say, but how realistic is this as a process? I mean, if we look at this as we say, is this really how we can start thinking about it? Well, it's only two pieces, isn't it? We've got a lot of other stuff we can add to this. We're not just left with this one piece of information when we start moving into the intermediates. And we'll go back through exercises when we look at the interns again as we go through this classroom. But we're trying to show you from the beginning to the end first, and then we'll take you through the steps during the rest of the classroom itself. So now we've got this pricing. We're now looking at this idea of being able to bid and offer for certain things. Now, if I look at a little slice of the S&P, now there's no reason why I've selected this slice, but it's just that it's a nice, easy to recognize slice on the S&P. Now you can start recognizing the value of being able to price the S&P based purely on one thing and one thing only, price action. So here's the S&P. It's, I don't know, Friday the 15th, actually, so it's just this Friday. And you can recognize certain things, can't you? We'll take off the top pins and we'll just put the current price band in here. We'll take off the bottom pin and we'll put it in there. And we'll say, how are you going to price this market? Well, think about how we priced this market here. You're going to say to me, well, you know what? I'm going to put in an offer here. Remember, this is the offer that's going to be available on this next candle because you don't know what's going to happen in the next candle. So that's going to be your offer. Where's your bid? Well, at this stage, you're going to be looking at that candle and you're saying to yourself, well, realistically, it's quite a strong sell side candle. I'm going to put my bid down at this price here. Yeah. So you've now got a bid in place. You've got an offer in place. The very next candle fills your trade and you're now short the market here. Okay, so you're now in a trade. This candle closes. Now remember, you're in a trade at 29. This candle now closes and somebody comes on the phone and says, give me a two-way price. I want to know what your bid and what your offer is. So straight away, you're able to do the same exercise. It doesn't matter. Forget about this sell trade. That's irrelevant to the next quote. So what your trade now is, you're now looking at probably 29 here. You'll say, well, leave it at 29 offered. And you're looking at this trade here and you're saying, right, the bottom of that candle was probably realistically about 25, 24 and a half. You know, we try and take the pin off most of the time as much as we can. And then you're going to be saying, right, I'm going to be looking at the end of this candle. And I'm going to say, right, well, I've got filled. There was quite a large pin on it. So I'll learn from that. And I'm going to say, right, I'm going to go 26 offered. And if I go 26 offered, I'm going to be looking at the volatility that's still developing in the current shape of the markets. And I'm going to go 26 offered. And obviously we'll go, you can see where we're going to go to. We're now going to go bid here at 21.5. Make sense? So what happens? The price trades down to 21.5. And you get your trade filled. And the price trades back up. Now, obviously, you've been filled in this trade, so this trade now gets cancelled. So just that tiny little process just got you short at 29s, and you just got long at 21.5. You've already made yourself 6-7 points, perhaps. It's a nice way to make $300 on a 5-minute chart. You know, being able to price the market accurately. You might say, brilliant example of a cherry-picked phase in the marketplace. Absolutely. But remember, this is the basics. We're not saying that this is what you will do when you're actually trading, because there's a lot more tools that we can call on to figure this stuff out. The point is that we can actually start seeing how the market is starting to behave. In other words, instead of just being a victim of the auction that develops, we're actually using the auction for the first time, perhaps for a lot of people, to price the market accordingly. We're starting to actually get involved in the flow of the auction. We're starting to recognize the speed of the auction. We're starting to pull our bids away when the volatility is increasing. We're starting to tighten up our bids when the volatility decreases. In other words, if this candle was a lot smaller, our bid would be a lot higher, wouldn't it? In other words, we start using some of that auction information as a measuring stick for what we would be likely to bid and offer for in the next market. Now, as retail traders, you're not going to be asked for two-way prices because obviously you're not making a market. But the whole point about this is, if you have a two-way price, the critical thing about a two-way price is this. The two-way price has a very, very strong habit of creating the next candlestick. And theoretically, this should make perfect sense. Theoretically, this should make 100% perfect sense. And therefore, when we come back to that original question is, what is the market and is it important for you as a retail trader? If you answered no, it's not that important, well, have another think about this question theoretically. Let's assume you're the only market maker. Might sound a bit strange, but there are periods when there's a very, very thin marketplace. But let's assume you're the only market maker. And let's assume theoretically that you're asked to price a two-way market. And we'll go to the left-hand side of these numbers for no other reason, but they're there on the screens anyway. And you say to yourself, okay, well, the 65 was the last traded price, so I'm going to offer 70s and I'm going to bid 60s. If you're the only market, maker available, and this is the only liquidity available, can you now see that if somebody wants to sell, they'll be able to sell at 60? If they want to buy, they can buy at 70. Now, of course, somebody could step in and say, well, I want to sell at 65, but they can't actually sell at 65. They can advertise 65 as a sell price, but unless somebody decides they want to buy it, then of course the market's obviously tightened up. That doesn't mean that you have to jump in front of them. You don't have to do anything, of course. You make your market, and if it decides that the price is below your market, then obviously that's not a bad thing. That's just information. But if you're the only market maker and you've made a market at 60 bid at 70 sell side, and it's a 10-point spread, in other words, you're making the spread just now of 10 points. If somebody comes in and they want to sell it, the only price they can sell it at is 60. And if somebody decides they want to come in and buy it, following that sell, the only price that they'll get is 70. In other words, you create, by your pricing of the market, you create the shape of the candlestick. If there's no liquidity at 60 and there's no liquidity at 70, nobody can sell at 60 and nobody can buy at 70. In other words, the price hasn't got any structure. If I want to sell at 60 and there's no buyers, I'm not going to be able to sell at 60. I might not be able to buy at 50. I might not be able to buy at 40. You know what I mean? In other words, the ability to price the markets is becoming incredibly important about what's going to happen next in terms of the basic structure of the market. This is, in some respects, in game theory, this is known as the Nash equilibrium. The Nash equilibrium basically goes along the lines of, unless there's an incentive to do something different, the price will keep doing the same. The incentive, and from a game point of view, is, of course, it could be a lot of different things. It could be a change in value. It could be a change in volume. Could be a change in the order flow. Nothing stays the same. So in other words, nothing is going to be a perfect Nash equilibrium trade. But we've got to start somewhere about our understanding of the markets. And this basic understanding is where the vast majority of retail traders simply just get lost. And what do? They want to go back a step to the intern process. They want to rejoin somebody else giving you the trades, the setup trades, somebody else calling the trade for you, and you just become an execution broker. Now, obviously, that somebody calling the trade for you is what a lot of people sell in the retail space. There's a lot of very good calls. If that's what you want to be, if that's where you need to be, because you haven't learned beyond that call, well, that is exactly where you need to be. That's where you should be. But what happens is a lot of people try and become traders, making their own decisions without ever properly being able to price a market. And that's where the biggest fall down happens. And then they go back, and they have to go back to just simply taking the order from a systematic trade order. Now, as I said, there's nothing wrong with that, but we'll obviously explore this in a little bit more detail as we go through this process. There's no fancy slides, guys. You'll know by now, we don't do fancy slides. We just do it as it comes out. So there's no fancy graphics. Everybody else does fancy graphics. We try to spend more time providing substance. And when we come back to this type of idea here, now let's take a look at this here. Now, this is just to allow you to consider the possibility of a real, proper structural trade. There's two structural trades on this chart. There's a structural trade on the chart itself, which isn't visible at this stage, and then there's a tweet. Now, you might say, well, a tweet, what does that give us? Well, a tweet gives us some information about perhaps something that's happening on the floor. A tweet gives us some information perhaps about some order flow that we're seeing. In other words, it's starting to inform your opinion as a market maker about how you're going to deal in terms of your pricing. In other words, you're not left alone to price the market from scratch. A lot of people worry about coming into a class like ourselves and saying, how do I even get started in this? It's just so much information to take in. It's not. You can wait, you can take your time because you can still do the order filling process, the intern's filling process. You can read the tweet on the right-hand side. The timestamp is on at London time, 11:27 a.m. And this is a tweet from our desk, basically my own desk, was that there was a lot of volatility desk buyers coming in during the London session morning. A lot of volatility desk buyers coming in during the London morning session, which should keep the top lines capped for the time being. Now you can see obviously from 11 o'clock on my screen here on the left-hand side, which is the NASDAQ, and I'm just talking about equities here, but this is the NASDAQ that's on the screen. Well, you can see what happened from that tweet. You can see what we said. It should keep the top lines capped for the time being. In other words, the actual physical orders that I'm seeing coming through are from volatility buyers. Now, does everybody understand that volatility, in most cases, is negatively correlated? We're talking about equities here. Volatility is negatively correlated to equities, and we can explain why it's negatively correlated to equities. A lot of people say, well, I don't understand why that's the case. We can go into that in more detail in the classroom. It's not really that important at this stage. It's just negatively correlated. So a lot of volatility desk buyers, therefore we should be capping top line shorts and trying to get sell side. Well, look at that sell, guys. Just on that tweet, if you did nothing else that morning. You were selling off the NASDAQ around about 570. You can see the NASDAQ up here. So there's the tweet coming out at 11:27. There's 11:27 right there. The price at that stage was 667. As a market maker, on the floor of the exchange, and you're seeing these volatility desk phone calls coming through, and they're all shouting buy volatility, buy volatility, buy volatility, buy volatility. As a market maker, what are you going to be doing in terms of that pricing? Would you be pricing this trade here as a sell trade up here at 720? Would you be pricing a buy on the NASDAQ at 660? So you'd be bid at 660 and a sell at 720? Would that be something you'd do based on this information? I would hope not. Seems pretty stupid to do that trade because you're never going to get filled. And if you do get filled, you're actually getting filled on the buy side of the market rather than what you want to be filled on, and that's the sell side. In other words, this information starts informing your opinion. It doesn't give you your opinion. It starts to form your opinion about top sides getting capped. And as a market maker, as a local, as a retail trader, you start looking for evidence that starts to support that information. And there's a lot of evidence available. There's volume, there's order flow, there's price action. Oh yes, there's price action. You just saw from the previous example where we tried to price up the market. That's all price action because price action gives us this idea about volatility, doesn't it? The actual historical volatility, not the implieds. So price action gives us historical volatility, and we can use that inside the Nash equilibrium to price the market properly. And as the market accelerates, we pull that side of the acceleration based on price action. So unless price action starts slowing down, we never get involved in bidding, especially in a market like this. Take a look at this phase here. So if the price action is important, during that phase there, you'd probably have never bought, would you? Because you'd have been constantly pulling away the bid and stacking the offer. There's a new phrase for a lot of people. Pulling the bid and stacking the offer. The good thing is you can actually see that happening on your Ninja Trader, your Bookmap. You can see that happening on your Jigsaw. You can see that happening on your Sierra charts. You can see it happening on any of your platforms that has an order flow component. Stacking the offer, pulling the bid, and then all of a sudden, that ability, that knowledge is actually you. You're the guy that stacks the offer and pulls the bid. Because you've just done it in an exercise at the beginning of this webinar. So obviously what you're doing here is you're stacking the offer and you're pulling the bid, and you'd probably never have get filled until it started to slow right down. In fact, you may never got a fill on your buy side until you started to see this kind of rollover phase here, where you started to see the price no longer moving. Obviously, what's going to happen is the bids that were holding a lot lower start to come up into the price. And we'll do a little diagram of this, but I don't want to draw on it just yet because there's a couple of hidden drawings on this that'll show you the interns exercise. If you followed our interns exercise, and there's a lot of interns exercises available, we'll teach you many of them, and you can develop basically your own exercise to do as an intern. Depending upon where you are in the world, depending upon your time zone, we develop the tools to allow you to do this as an exercise. What it does is you can develop your own phone call from the broker. And then you can start pricing it out for yourself. You don't have to just follow the one exercise about what we do. We show you how to do them. So let's take a look and let's see how you would have done on this trade using our tools. Very simple. Let's see how you would have done. And there's the trade. The first thing I'm asking, this is Friday's, right? This is Friday's. We basically had two trades. It's a buy-side, sell-side volatility extension. Remember, this is an intern's trade. This is a very fixed trade idea. And obviously, the idea of this very, very fixed trade idea, there's the sell box that we had in terms of this intern's trade. Lots of volatility desk buyers this morning. Now, what we're trying to get to is when you see these interns trades, you now have the ability to either just take the intern trade, just go with it, or interact with it. In other words, start using the information that the intern's trade gives you to start figuring out whether you want to or whether you don't want to take this particular play. Some of you will end up costing you money, in which case just do the interns exercise, just stay with the interns until you figure it out. And other times you'll say, well, I did very well there because that would have lost me one profit. That would have lost me a small amount of money on that occasion. I did better than the intern would have done because I knew that that was a bad play. Well, if this is the shout here, for example, and then this is the intern's trade here, you could have obviously have sold the intern's trade taking the top edge because you were told top lines were capped. So you could have had that intern's trade. And then without that, you simply see the indicator trade here. Now, these are the actual prices you would have got if you just did the interns. And the trade you would have exited on would have been this trade here. You'd have exited into this play here. You'd have sold at 15,693. You'd have sold at 15,592. Your exit for both those trades would have been 15,378. Assuming you kept both of them, you made 315 points profit on the first one. You made 214 points profit on the second one. You made 529 points in total at $20 a point, which would have given you a $10,580 profit on Friday. $10,580 on a E-mini NASDAQ position. Now, that's not a bad day's work for an intern. But does that make you a trader? No. It makes you an order filler. It makes you the guy that's on the phone taking the order. In other words, the order is quite clear. Sell me. The order is quite clear. Sell me. The color is quite clear. Sell me. The color is quite clear. Sell me. In other words, there's no ability for you to be long. There's no ability for you to say, I don't like it. There's no ability for you to interact with it. In the first instance, all you're doing is getting that deal done because that's what the deal tells you to do. And as an intern, you don't know any better. As an intern, you don't want to know any better at this stage. You're trying to learn. So you start to build out these as ideas. You start to build out these processes. And what's going to happen is you're going to start saying, can I find a way of maybe maximizing some of these sales? Can I find a way of not taking some of these sells or buys? Can I find a way of improving on this process? Well, now you're starting to ask the right questions. The good thing about it is, if you decide to start asking those questions as an intermediate, what's going to happen, of course, is that you're going to start finding that sometimes you'll go backwards in terms of your performance against the intern. And sometimes you'll start moving in front of the intern's performance. The best case scenario is that you always move in front, because if you can't move in front of the intern, guess what? You're better staying as an intern. You're better staying as an order taker. You understand? And that's not disrespectful, by the way. It just means that you understand that you're not interacting in the process. And as I said, for a lot of times, getting out of your own way is a good thing, right? Some of you might agree with that. Some of you might say, well, that's one of the biggest stumbling blocks I've always had, is that I keep getting in my own way. I cut losses too late and I let profits run for about 1 or 2 ticks, and all of a sudden I'm out. Well, you're getting in your own way of success there. In other words, the interns process, like a lot of interns process from some of the other guys that have a set target price, for example, or a set profit target and a set stop size, or a variable target price based on other things, or a variable, depending upon a reverse setup, then that's what we start recognizing about some of these little easy money processes. We should always be better than this. Now, on days like Friday, it seems very easy to simply have made $10,500. It's simply no challenge. There's no effort. You simply fill the order, and then you just laugh your head off because you made so much money on a 1 lot and a 2 lot second add-in basic entry. You just made so much money. But that doesn't happen all the time. We're showing you this example because it did happen on Friday. And that's the problem. On a lot of days, this isn't going to happen. On a lot of days, you're going to look at this and say, damn it, why is that guy giving me a sell order? Why is that trigger giving me a sell order? I know fine well that that's a bad trade. So you want to be able to do something about it, but you want to have the tools and the ability, surely, to say that's a bad trade. I want to know that that's a bad trade. I want to be able to interact with that as a bad trade. And we're obviously now going to cover some of those interactions when we move into the second half of this little classroom. So going back to this, at least you've got the ability to fall back on the intern's exercise, using a structure that gives you the idea that you start to now try and only fill in the direction of the market move, pricing the market so that when you do fill, you're getting best execution. In other words, what do we start learning as an intern? First of all, we learn about structure. First of all, we learn about the intern's exercise. First of all, we learn about making sure we don't make mistakes. First of all, we learn about momentum. First of all, we learn about pricing that momentum. And what starts to happen? We start to price the market based on momentum, based on side, based on the big board, based on the color of the market. If the market's red, we want to be predominantly pulling away bids and stacking offers. Well, if you think about even the difficult phase, and there was only really one difficult phase, which was in here. If you pull away bids and stack offers, and you start looking into that little area there, and you start looking at that and saying, well, you're pulling away bids and stacking offers. If you were to do the same exercise that we just did at the beginning, and you say, right, what price are you offering? You'd still be able to pull away your bids, your offer price, wouldn't you? You'd be able to pull away your offer price to the point where the volatility, the process, the speed starts slowing down on the way up. And you can start looking at it saying, right, I'm starting to see even a slowdown here. The difference in the spread is getting less and less and less. And we give you some tools to help you get into a trade like that, where you see that slowdown taking place. We have a Heisman trade that would have put you into a sell trade, for example, just in there. And you'd have been able to rejoin the short sell as early as possible. And if you missed the Heisman trade there, you maybe can go for the tipping price trade on this failed auction here. So we can go for a tipping price trade as this starts to roll back towards the bottom edge. We can go for a BSG squeeze trade just in here. And then we can do the interns trade. And the interns trade is not guessing about any of this. The interns trade is simply to take that blue candle right there as a possible add-in. And that blue candle made a lot of money. Now, this isn't part of your original interns exercise. This is a possible bolt-on interns exercise. But here's where I want you to think about this. You've just looked now at the intern's exercise here, and you've recognized how amazing that short is. What I want you to do is now look across at the same trade setup prior to that amazing short. So you look at the intern's exercise and you say, well, I'd be selling that blue candle. Oh, damn it, I've just lost some money. And then you'd be saying, well, I'm going to look at that blue candle there and it makes some nice money. And okay, it does okay. And then you'd be selling that blue candle there and you say, okay, well, I've managed to make at least a bottom line and it's flipped me back off the bottom edge. And then I've gone and shorted again here and I've lost some money. And I've just gone and shorted it again here and I've lost some money. In other words, would it not be nice to be able to interact with this area so that you wouldn't have had that loss, that small profit, that scratch, that loss, and that loss? You had 3 losses, a small profit, and a scratch. In other words, that was a losing period. You might say, but as an exercise, if I look at the previous trades, I would have had a short sale there that made me some really nice money and a short sale there that lost me money. So you'd have been able to sell against that one, lost money, sell against that one, made money, sell against that one, lost money, sell against that one, made money, sell against that one, maybe scratch, sell against that one, lost money, sell against that one, lost money, sell this one, make a lot of money. So you could have traded in that direction. Now, would it not be nicer to be able to still be able to recognize, first of all, that there is a sell still in place? Would it not be nicer to start then looking at this and saying, right, using my intermediate skills, the guy wants to still be short, but I don't like how the structure's setting up. I'm going to start quoting this price. I'm going to start quoting this price. I'm going to start quoting this price. I'm going to start quoting these prices. And when this starts to go into this phase here, you might quote that price. In other words, you start pulling away a little bit of your bid. You start pulling away a little bit of your offer. You start widening the channel a little bit. And you say, well, you know what? I'm still bearish. I still think the bearish trade is the right trade. I can see the color of the big board. I want to be short, but now I can do better than simply filling in with an exercise here. I can do better. But the good thing is that even if you can't do better, you can still join in if the intern's exercise still says it looks good. So you start developing a thirst for this new information, a thirst for knowledge that tells us what was good about this one that wasn't so good about these ones. It can't all be in the price action. It can't be all in the volume. It can't all be in these obvious things. It must be in other things. It must be in other elements. Well, the answer is yes, it is sometimes in other elements. And sometimes it's not. Sometimes we don't get the fair value. Sometimes you just see a move like this and you say, well, there was no way into it except for a fair value short sell from the interns. In other words, we develop our knowledge to go with the flow, but these are add-on elements. You can choose which add-on elements you want to do. In a red market, you might say, well, I'm only going to sell higher highs, in which case, of course, all you're doing now is looking for a higher high coming in from structure, and all you're going to now do is sell those higher highs. In other words, you would have probably had a sell trade there. You wouldn't have had a sell trade there. The next sell trade would have been this break higher. You might have then sold that little Heisman there, and then when it breaks higher, you might have sold this Heisman, and then when you sell higher here, you got this Heisman, and that was it. That's all the trades you would have had. In other words, you start to learn the ability to sell into the trend, which is sell side, the ability to join this as a seller, profit, and a scratch, seller, profit, and a scratch, seller, big profit. Big profit. So we can start adding this as a process, can't we? And even if we go back to earlier in that phase, you'll see that selling higher highs could still have made a little bit of a sense. There was a higher high there. You can see that you could have got a little short sell against that higher high Heisman trade just there. When we make a new lower low, we can start selling higher highs. There's a higher high there. You can see it still made some money. Not a lot of money, but it still made some money before it then doubled back and maybe scratched you out. You might not have liked the higher high. You might have liked it, whatever. You still, if you sold it, you'd still be able to price it properly. Remember, during this process, you're learning not to just draw straight lines, but you're learning about pricing this candle, for example. So if we go back to that candle here, and I said to you, right, you're selling the market, I want you to sell the market, but I want you to price up the market properly. So I want you to price this market properly. You'd be saying to yourself, right, I need to know a little bit about structure. I need to know a little bit about this candlestick. And I look at that candlestick and I say to myself, okay, so this is what I'm faced with. You're wanting me to sell this market. Let me just work out what I'm going to sell it at. And you come up with a little area. Remember what we did in the previous candle where we just took off the prior pin, we took off the bottom pin as well, and we just gave ourselves a price. And we're going to put an offer into place at that stage. And that offer is now going to be that size there, based on the Nash equilibrium. So you're going to price this at 48.75. Already you've learned something. Already you've learned that this is your current offer already from this morning's classroom, this evening's classroom, whatever it is for you guys. You've learned about pricing this market properly, which has kept you out of trouble during that move higher. It's ran the previous high, which is good news because it now forms part of your rules. It's ran the previous high. And because it's ran the previous high, you're now looking at that price as the relevant price point to start selling into. It now fits in with two of your rules. It is an offer based on the volatility, and it's an offer based on your structure. And now you can sell into that as a move. You're happy that you see a little smaller candle here. Now, some people might say, what happens if it just sells off? Well, if that candle sells off, of course, it hasn't accomplished one of your rules, which is to sell into a higher high. So no trade. If it just immediately sells off, then you might have another rule, which says, worst case scenario, if it doesn't make a new higher high, then I want you to sell, for example, the Intern's breakout of the prior low. So you've got a sell order resting here. In other words, you've got a sell order at this price and you've got a sell order at this price. You can't now miss the trade, can you? You can't now miss the trade. You can, of course, adjust these as it develops. And this is when we start moving through these intermediate phases. The Intern has the rule. The Intern says, sell a higher high if it then falls back inside the higher high. That's the Intern rule. You're not making any decisions. The price goes above the higher high. It falls inside the higher high by one tick. Your job is to sell it, put a hard stop at the higher high. And then the Intern's rule would be take a profit at whatever. The intermediate is think about what price you might want to offer it at so that you get an extra 2, 3, 4, 5 ticks out of this trade perhaps. And then we start to develop a little bit more understanding about the execution. We're not having to worry about what the trade is. The color in the background tells us it's going to be a sell. And now what we've got to try and do is build these execution strategies around the fact that we want to be selling. There is no buy available in the Intern part of this exercise. If the background color is red, there is no buy opportunity as an Intern. All we're now going to be trying to do is develop your execution, get that pristine execution, start introducing you to the proper stacking on the book, start introducing you to the leans, start introducing you to the various order flow type entries. You can do a pro trade entry, which is a fade. You can do a Heisman trade entry, a tipping price entry, a BSG squeeze, or you can take the breakout Interns trade. It's 5 specific trade entries, and that's it. That's all you have to learn. And there's an execution strategy with each that you want to make sure these execution strategies are in place. The stack's in the right place for the momentum trades. The flip is in place for the fade at the top edge. You can either fade passively by limits or you can fade aggressively. It might sound strange, but yes, you can fade aggressively by leaning on a big order flow. In other words, you can do what we call the transition trade, watching for books transitioning from bullish to bearish, for example, in this case. And then you get executed. And because you get executed in that trade, you pull away that stop order. And obviously the trade trades perfectly down to the bottom edge. You've already got your structure in place. You already know where your target prices are. And that's a great trade. You get sold on that trade there. You got sold in that trade there. You obviously got filled if you were using that exercise that we did, exercise number 1 that we did this evening. You got a price of 8.75 and all of a sudden it's trading at potentially down at 18s. Think about that. 48s to 18s, 30 points. 30 points on a 1 minute chart, guys, in 10 minutes. $600. Seeing the color in the background and even going through the interns exercise, still being able to get that short sell on your books. And even if you didn't get the pro version of it up here, you were able to get the structural version by selling into that move there, by selling into that move there, by selling into this move, and by selling into this last leg move. Any one of them would still have made you more money than most people make in a day in the retail space. Any one of them. And this is just one example of a day that made $10,000 on the short sell. So in other words, as an intern, we start learning what the trades should be. As an intern, we start taking the phone call from somebody else. And that somebody else could be anybody. It could be Hubert. It could be a level. It could be something that you use from ourselves. It could be something you've developed for yourself. It could be anything. It could be a stochastic if you wanted it to be. That's the phone call. You're not making the decision. The decision is being made for you. And your job is to understand whether that decision has a positive expectancy or a negative expectancy. I would assume if it's got a negative expectancy that it should be dropped very, very quickly indeed. Why would you use it? If it's got a positive expectancy, what you're now going to develop is you're now going to develop the tools to improve on it as a trader. You're now going to be interacting as an intermediate. So you're moving through the intermediate phase where you still know it's a sell trade. Now what you're trying to do is get best execution as your second phase. Knowing what the trade is and now getting best execution allows you to now develop into the professional rankings, where you decide whether you even want the trade in the first place, whether you want to do that trade, or what trade have you got yourself. In other words, you start pricing the market very fluently in the right direction nearly all the time, and you make consistent, steady profits. So let's take a look at some of these as examples. And we'll look at the different ways we can start looking at some of these. And we'll go all the way back to this guy here, where we started. So now you've got a better idea about what's the market. What's the market is not what the bid-offer spread is. What's the market is what your bid-offer spread is. At the moment, as an intern, as a beginner, or as a new member of the classroom, your market is basically whatever the rule tells you it's going to be. As an intern, if the phone call comes through and says, buy me 500, you buy 500. You don't care what the price is. You just get that 500 done because that's all they wanted you to do was buy 500. What's going to happen is you're going to start understanding that informed information. Is this 500 an exit or an entry? Is this 500 usually always making money, or do they nearly always make money? Does this guy that wants the 500 trade, is this guy telling me something that I should now have as a local? Is this guy telling me something that I should have as a professional trader? Is this informed trader now giving me information that I want to take to the market and verify, check, and then properly price? Because it doesn't take away our ability to price. In fact, it enhances our ability to price the market because we now know that they want it. So if they want it, I want to know where they want it. If I was going to be doing the order for them, what price as a order filler, as an execution broker, what price would I now be trying to get for this guy? We'll look at a lot of examples as we go through this. So what's the market has a whole new meaning, doesn't it? So let's take a look at some of these examples here. Here's a chart on the right-hand side, and this is on the right-hand side, and we've got a couple of R-squareds for us. What's your first immediate thoughts on this? We've now got some information to play with here, haven't we? We've got some market feedback, haven't we? What's your first gut feel? What is the R-squared on this? I'm specifically looking at the blue and the green. What is the R-squared on this? Good? Poor? What would you think? Well, if you understand R squared, of course, I would think the answer is it's a pretty good R squared run in this, isn't it? It's a pretty good R squared. In other words, we can probably rely on these calls. We can probably rely on whatever this is. It doesn't matter what it is. All we're asking is it a good R squared? And the answer is yes, it's a good R squared. We can interact with a couple of these deals. So if you were to ask what was the R squared here, I would say, okay, the R squared, what would the price be based on R squared? At this stage here, the price was running at this point here, which was 124.29s. I'd say the price is probably going to be trading one at 25 evens. So when they come into the markets, back into the dip here, I'm getting a price of 27s. I quite like the idea of bidding the 27s against that narrative. I like the idea of maybe getting some business done at 27s. I look at the volatility, and the volatility is only a tick wide. So when I look at that idea there and you say to me, okay, R squared seems to be giving me a strong buy trigger, or this phone call seems to be giving me a strong buy trigger, this guy is buying this trade, what are you going to price it at? They're going to say, well, I'm going to bid 27s. I might even bid some 28s if the value is good enough. Now, you could obviously look at the volatility, the small volatility, and you say, well, I don't think there's going to be a lot of opportunity for me to start bidding 24s, but I might start at 24s and 25s and 26s, right? I might start down here, and I might look at this price and see that this one's not going to go anywhere. I look at the volume and I see the volume's dropped off to nothing, and I say, you know what? I'm going to bring my bids up. I'm going to start bidding 27, 28s. And I pay 26, 27, 28s, and obviously the trade goes nicely for me. If I didn't have that ability to price the market using the simple basics that we taught in the very, very first part of this classroom, you might have been looking at that and saying, right, I'm going to pay 20s. You're not going to get filled at 20s, are you? So the first thing is that we start getting the phone call. The phone call in this case is the green line, the blue line divergence. The phone call in this case is something that gives me information. The green line is buying. What is this going to do for me on the bond pit? The green line's buying. I'm going to go and bid this at 27s. I'm going to bid this at 27s. If I was bidding 24s, 25s, because I was expecting a break of the bottom edges and I was looking for some liquidity, it is now up to me to bring that bid up into the price. In other words, get involved. Okay, so on the right-hand side, the question I've got for you is, what is your bid? What's your bid? For some people, you might look at it and say, I've absolutely no idea. It looks kind of fair to me. Okay, so if it looks kind of fair, what's your bid? What's your offer? The volatility seems to be extending a little bit, doesn't it? But what other information have we got available that starts to show up on this chart? The other information we've got available seems to be that there is a lot of volume in these two down candles on the right-hand side here, isn't there? There was a lot of volume in this crappy little down candle here. There was a lot of volume in this down candle here, and there was a lot of volume in this down candle here. The volatility is extending, so I've got to be careful. The value looks fair, so I've got to be really careful. So if you say to me, what is my market? If you make the phone call right now and say, okay, I want you to quote me a two-way price, I'm going to quote you 26 bid, 06 offered. 26 bid, 06 offered. You're going to say, my God, are you not hiding from the price? Absolutely. Because I don't want filter here. I've got no idea what the edge is. I've no way of knowing what the edge is. I'm not going to want to quote a price of 30 at the handle, right? I'm not going to bid 30 and then offer 125 evens. Because I don't know which way the price is going to go. So this is a lot of volatility coming in. I want to avoid that volatility until I can get a read. Does that make sense? In other words, I can do this exercise anywhere on the charts. In other words, if you look backwards to the left-hand side, you'll see probably the only trade that you would have bid for was probably that trade that we talked about in here. Everything else would probably have been almost impossible to price up properly with an edge that we might have been able to take advantage of. You might have been able to argue about what happened on this candle, about a possible sell off the twos. Yep, perhaps. But personally, I would have probably still been looking at it saying with the volatility in the background, I might be willing to pay threes or offer threes, sorry, for this trade. I might be able to sell at threes, not twos. So perhaps a little bit skinny for the twos and therefore just simply no trade for me, right? In other words, do you see already the difference in your trading? You're now starting to price the market properly. You're starting to get aggressive when you need to get aggressive, passive when you need to be passive. You're using volume as a tool. You're using the volatility as a tool, the auction as a tool, and the R squared as a tool. In other words, you're starting to become almost like a professional trader. My goodness, so soon. So let's see what happens. Let's take another attempt at pricing up this market, guys. Let's take another attempt at it. Oh, wow. Okay. Now that's interesting, isn't it? So those of you that priced up the market at 30 as a buy, you've just been bought at 30 and you're currently underwater a little bit. Those that priced it at 29s, 28s, currently underwater a little bit. If you priced it at 27s and 26s, congratulations, you're making a little bit of money. If you priced it below 26s, you've not been filled. If you price the offer, which I don't think anybody would have done, but if you price the offer at zeros, you've actually made okay money. You've made yourself 4 ticks there. That's okay. That's a decent start to your day, isn't it? If you got filled at zero, that is. Okay, so what are you pricing up the market now? Now, this is quite dangerous. There seems as if on the face of it, as if we've got a lot of value to bring the bid up now a little bit, doesn't it? It looks as if we stack the bid into the 26s, 27s. We might be in for a good trade. However, we've got to be aware of the fact that there was quite a heavy sell-side auction. So we've got to be mindful of the fact that there was a sell-side auction. We've got to be mindful of the fact that if we're just now trying to decide at this point, what is your market, that there could be the possibility that this could drive through the bottom edges. And you've got to take that into consideration. Let's move forward. This is what happened. So there's that trade that we've just been looking at. You'll see it's at 1:30, which obviously is a data release at time of the day as well for the US session, of course. So you've got to be careful with the trade. You know it's a bid. You know it's a bid. And obviously, when you look at what happened next, you can see that the bids, they did come back in at 27s. And then they went bid away from that price and they managed to make a very substantial sweep up to 15s. So the worst case scenario is you never get filled because you pulled away the bid because of the volatility. The best case scenario is that when you started to see this candle forming and you started to see some value divergence, yes, there was a tiny little turn down here, but it's okay. We can see that there's a lot more value in here. There's some value coming in here now as well. Then there's a very good chance that if this price goes back up again, we're going to start being able to make a play. If you missed that trade, there was still a chance that this represented some real value. If we look in the background on all of these R squares, the green is substantially higher than this candle here. The blue is a little bit lower and the red is a little bit higher. So the green substantially higher. The price at that candle was 25 evens. This candle during that candle traded a low price of 28s, 29s, 30s. In other words, if you were trying to price that candle up against R squared and against the fact that the volume dropped off to very, 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 very small volumes, you'd have started to look at this and say, you know what? I'm not sure how far the price will go. We've went from, say, threes down to this 31s. So I'm going to be thinking that it should do about 27. So I might start bidding some 27s. The price trades 28s and it goes 29 bid. And you say, nope, I don't think it's going to pay 27s. I need to see the value. And if the value is still good, you go ahead and you pay 29s for the trade. You start crossing into the spread. Can you see how the volatility starts informing your opinion? It's better that your bids are too far away at first. Your offers are too far away at first, because the good thing is that as you get more used to this as a process, the market that you're making is tighter on the trades that you want and a lot further out than the trades you don't want. In other words, you start forming the shape of the candle that's going to happen next. If you started to bid 27s based on this value, your offer would not be until 05s, right? Well, guess what happened? The price went from 26, 27s, ultimately traded 03, 04s, nearly 05s that where your offer was. And obviously, when the price trades up towards your offer at 05s and the value is now putting higher highs in, you're not going to have your offer at 05 anymore. You're going to pull your offer away to 10s and 11s, perhaps. You're just moving the price based on the volatility that's starting to show up. The ability to keep readjusting these as ideas is where we'll spend the first whole phase of intern to pro. The ability to keep moving your bid and your offer and then bring them into play when they're ready to deal. Bring them into play when you think you want to bring them into play. The exercises that will get you doing in the intern to pro exercises is going to be being that order flow market maker, being that execution broker, trying to get the best prices on a 3 lot, on a demo account. And we'll be asking you for your fills. We'll be asking you for your average price on those 3 contracts. And we'll be seeing who gets what. We'll be seeing how accurate you are. We'll be seeing you in terms of how your execution is developing. And you've got to get those deals done, because guess what happens to an intern that doesn't get the order filled? Well, they don't stay an intern very long. They're off to the stacking the shelves of the local supermarket very, very soon afterwards. You cannot be an intern and not get the trade done. In other words, it teaches you to get the trades dealt. In other words, it teaches you to get your execution as best as possible over time, because you will be compared to your peers. You don't have to tell us what you got, but it's a part and parcel of your learning process. You start to interact with the idea of getting the best price without missing the best price. You start developing strategies around getting the best price. And all of a sudden, the learning you get from that best price start to make sense. Now your execution strategies can be used when you start developing the pro techniques. So the tools are not lost on you. The exercises, the learning experiences are not lost on you. It's a building process towards a pro. Let's keep going. So if any of you got filled in this trade, in other words, if you looked at it, let's go back through the process again. The question was, did anybody fancy this trade? And everybody said no. And we asked you what the price is that you would bid and offered, and you would have said 26.06. I think that was the price we said, 26.06. So we're bidding 26s, we're offering 06s. Why? 26 was the prior low, 06s was the high. Well, 05s was the high, okay. 05s, right? So that's your bid at 26 and your offer's at 05. So that's step 1. Step 2, we started to see the value starting to improve dramatically. Your 26 has just been filled. It's bounced off 26 to 28. The value is rocking to the upside, putting fair value probably about 0.2 realistically. So even if you never got filled at 26, you say, give me 27s, get me some at 28s. Your offer's probably pulled away from 5s. It's now sitting in maybe 8s. You've just been filled on a bond trade based on R-squared, based on volume, based on price action. And the final step to that is that you get a nice break back up to 4s. You have to make a decision about what to do. You get another opportunity maybe to buy some more at 28s, 29s, 30s, and you trade 15s over the course of the next 15 minutes. That is professional trading. Now, inside this, of course, there may be an intern's exercise that you can also do. You can use things like volume analysis. It could be levels. It could be keys. It could be a shout from the trade log. These are the phone calls. And we'll come to those in a minute, because now we're starting to understand the importance of pricing the market. You're still having to make that decision about whether you want to bid for this or offer for it. In other words, this is very much part of the pro exercise. Let's carry on a little bit and see how you get on with this one. What's your marker in this one? This one seems to be a little bit easier. What's your marker in this one? You'll see that it's the Treasury bond again, 125 26s. Are you getting aggressive on the offer in this or what? What's your market? So you might say, well, the volatility is at 25, 26. It seems quite small, but there was a gap up from 24, so I've got to be careful. So you might say, right, I'm going to offer 28s. I'm going to offer 28s, and that's my offer, right? That would be reasonable. What are you going to bid? Well, the value is dropping, but the price is going up, so I'm going to bid, say, 21s. I'm going to offer 28s, I'm going to bid 21s. Anybody think any different? Anybody a little bit more aggressive? Anybody a little bit less aggressive? Think about what you're starting to pick up now. You're starting to see the market properly. You're starting to price a market with a two-way price. You're starting to think about spreads. In other words, you're starting to think about volatility. You're starting to think about the shape of a candlestick that might eventually develop because of the bid and the offer spread that you're developing. Let's see what happens. So at the moment, you're maybe offering some 28s because of the gap. You're 2 points higher. 28 seems reasonable. What happens? The price doesn't trade 28s. So what do? You cross into the spreads and jump it, and the price trades 25s, and you say, right, get me in at 25s. We never got filled at 28s. I was expecting the price to drop down. The price did drop down. In fact, we went from 26s down to a low price of 19s. Very nice profit as a bond trader. Maybe you like the idea of selling at 26s because of what happened in this candle. In other words, you started to bring your offer down into the price when you didn't get filled on your price. Because of what reason? Because you knew what the skew was. You knew what the skew was because you knew what the spread was. If your bid offer spread was 10 points and it was all skewed to the bid side, in other words, it's all skewed to the downside, then of course you can cross into the spread because you've got about 10 ticks to play with here. If you've got about 10 ticks to play with, you can afford to give away 2 or 3 of them. So if you're sitting on the offer at 28s, you can start saying, you know what, it's just traded 25s, it's gone 26. If it breaks 25, I'm going to sell 24. And when it sells 24, you're in it. Okay, we get a spike. We don't know what that, but we get a spike down here and we get a big spike down here. So on balance, your R squared is still bearish. So you're absolutely right about that 24. And that is a big volatility candle. Based on the big volatility candle, you'd be looking at that saying, okay, well, I would imagine this should easily do 20s. And obviously, as you start to develop out the volatility stories, the volatility starts turning and you start looking for the next opportunity. Here's another example. This is a little bit harder again. What's your market? What is your bid offer spread? And what is your skew on that bid offer spread? There's a couple of things that seem to stand out for most of you, but do you see already, if you've started this classroom with us so far today, the first thing you're now looking at is you're now looking at this and saying, my God, it's kind of volatile. Would you agree? Are you starting to pick up on this, that it's quite volatile? You've just seen a candle that's gone 21 from 12s, right? So you're looking at around about a 9-point move. So you're already thinking to yourself, well, realistically, I can't offer any less than, any less than 30. Agreed? Do you want to bid for it, though? You want to bid 18s? You want to bid 16s? There's a couple of R squares that are a little bit against bidding too aggressively, correct? In other words, what you're doing is you're widening your spread because you're not getting a clean shot at this trade. You're widening your spread so that you don't get filled. You're widening the spread so that if somebody wants to do business over the phone with you, that you're not going to end up getting trapped on a trade you don't want to be on, which is the market maker part of this process. But by learning that part of the process, you as a retail trader also don't get filled. So the bottom price is 12, the top price is 21. And you're looking at it saying, okay, so we've got around about 9. I'm looking at 30 offers. Okay, I'm looking at offering 30. Let's see what happens next. Now that's interesting. The price spikes up to 27 and comes back down again. The value is now starting to drop on two of your R-squareds. Slightly rising on this one, slightly dropping on this one, and dropping on this one. You've just seen the top edge 26 traded. It's ran it by one tick and it's dropped back down again. And you're going to look at this and say, okay, so I never get filled at 31s. Assuming you're now just looking at this information, I don't know if it's a good trade yet, because I'm not getting a great price at 23s. We've already seen a 27 traded. So obviously you're going to be looking at that as well. I don't really want to pay 23s for it. There is one R-squared that's a little bit against me. The one R-squared that's against me actually tells me that this price may want to trade 26, 27 bid. So I'm going to look at that and say, well, I don't want to go too far out the top edge. I'm going to offer some 27s and 28s. Reasonable? I'm going to offer 27, 28 on this candle because this is too low for me. This price is too low. Do you see how you're starting to become really focused on the right price? You're starting to think about the volatilities. You're thinking about the candle, if you like, the volatility, the price action on the candle. You're taking into account the previous candles. You're now looking at R-squared elements. You're now looking at volume elements. If you were looking at order flow, of course, you'd be looking at the stack and the offers. Let's see what happens next. Whilst you're doing these exercises, by the way, think about what you would be pricing the market at. These aren't just irrelevant exercises. These are things you can take away. If you decided not to join us at the end of this classroom, you can take away these exercises and start pricing the market a little bit more accurately based on some of these elements. As we move into the answer to this question, you'll see that this is what happens here. Again, the price doesn't trade 28s. So you've now got a decision to make. The price starts rolling down. Do you see how though we went from 30s to 28s? Do you see what happens? Every time you start finding that you're dropping down your offer and you're pulling away your bid. We were originally offered at 30, correct? And now we're offering 28s. And because we offer 28s, you can already start to recognize that you're collapsing the offer and you're pulling the bid. You're collapsing the offer and you're pulling the bid. So guess what that does to the shape of the next candlestick? It starts to send the candlestick down. In other words, you start watching this price open and it opens at 23 and it trades 24. And you start watching your R-squareds and you start watching to see if they're getting better or worse. You start reading the 25s. You start looking at the stack at 25s. You start recognizing an offer coming in at 25s. The stack changes from bid to offered. You put your hands up and you sell 24s. You put your hands up and you sell 23s. You're now using the transition trade to now join the trade that you wanted to do. Not on a passive 28 because you never get filled, but on a transition trade because you saw the elements that allowed you to now get into that transition. In other words, you're not just a static, lonely figure at 30, waving your hands about, trying to get a sell, trying to get somebody's attention. You're not going to be selling 30 on the floor anyway because you're going to get a bad name for yourself trying to sell 30 above the market, but it doesn't make any difference. The point is that you're not that guy sitting on an offer that's outside of the market, just hoping and praying they get filled. You're actually hoping and praying you don't get filled. Because the interesting thing is that you'll learn is if you get filled on a limit offer, you'll probably go underwater by a few ticks almost immediately. If you don't get filled on your limit offer, but instead you start chasing and crossing the spread, I'm not saying about pricing this market and selling at 16s. I'm thinking selling at 24s. I'm thinking selling 23s almost immediately when you know your 30 is never going to get filled. That's a good thing, not a bad thing. That is a very good thing, not a bad thing. If 30 gets filled, this price will probably trade through the handle. You'll probably lose money. So these kind of ideas are very, very good news. If your limit order doesn't get filled, that is great news. It's only great news, however, if you've got the tools to take advantage of that knowledge. by selling as the market started to move out. Let's take a look at something else. The UK gilts market. My God, that's another bond. Yep, I'm afraid so. UK gilts, what's your market, guys? Now, this should be relatively easy for you guys now, shouldn't it? I mean, look at it. What's your market? Come on, right? Well, there's a couple of things. There's a couple of concerns, right? What are the concerns almost immediately? The concerns almost immediately are that there's a bit of volatility starting to come in here. The concerns almost immediately is that somebody came in at 95.5 and bought this market. You can see that straight away. Somebody bought at 95.5. What the hell were they buying 95.5 for? Why did they buy 95.5? Would that not be a nice thing to understand and learn? Well, we tell you why they bought 95.5, and we tell you what they're going to do about it because you'll know why they bought 95.5. According to R squared, we're not trying to trick you here. According to R squared, it should be relatively straightforward. I want to sell this market, but they bought 95.5s, right? I'm looking at 52 at the bottom of the candle, and I'm looking at 57s. I'm looking at a 5-point spread on that candle, right? 5-point spread. 5-point spread on 57s would probably price this at 95.62. So if you ask me for a price, I'll offer you 62 at the moment. I'll offer you 62. My concern is that the market looks really bearish. I'm also concerned about that buyer at 95.5. I don't want to be a buyer myself. So I'm not going to price the buy side at 50 or 52s. I'm going to price the buy side at 44s. In other words, I'm widening the spread quite substantially here. 62 offered, 44 bid. You might be saying, is that not hiding? No, it's not hiding because you're using volatility. Now, what I'm hoping to do is I'm hoping to come off the 62s and start maybe paying some 60s or 58s for this. I hope I don't get filled at 62 because then I might be wrong on this deal, right? Let's see what happens. What would you price this market at? And see if it starts to line up with a 40-year veteran. See if it starts to line up with a 40-year veteran of the UK gilts markets. What would you price it at? Were you a lot higher? Were you far too tight to the market based on this information? Well, we're telling you this is where you should price the market, and we're giving you the ability to think about that for yourself because it's a 5-point spread. So you just give yourself a bit of room to see it happening. I want to see what happens next. I've got a top edge there at 58s and a top edge at 62s. I want to see what happens. I want to see what they're going to do up here, right? So let's see what happens. And there's what happens. Look. The next candle has a little inside mix here. Doesn't do very much. The next candle goes 56 up to 60. The volatility is extending again. Now, that could be as a result of this liquidity getting taken out here at 58s. And now we're going 56 to 60s. So I'm going to pull away my 62 offers. Agreed? Everybody happy with that? You're pulling away your 62 offer. You're not bringing your bid in because there's no way I want to bring in my bid, right? I want to leave my bids where they are. I want to leave my bids down at 42s, 40s. But I'm pulling my offers. In other words, I'm widening my spread, but I'm still very, very close to the current price. I'm now at 64s. Why 64s? 56 to 60. I'm going to do a 4-point spread on this, and I'm going to sell 64s. So I put a hard offer in at 64 for this product, right? Do you see what's happening? I'm not getting filled at 62s anymore. In other words, I'm not a victim of the price touching 62s and then running the stops at 62s. I'm reacting to what the auction's telling me to do. I don't want to get filled at 64s. I want to get filled at 63s and 62s, right? I don't want to see anybody up here at 64s. If I get filled at 64s, I'm probably going to lose money. Oh, now, this is interesting, isn't it? This is a little bit more interesting. The volatility slowed down a little bit. 60, 62. So if you said 58s, you're now underwater by 4 ticks, and you've not taken into account the volatility and the stops, so you've came in a little bit too early. So now you're starting to learn something new. something else. You're pricing the market more better. You're still aggressive on your pricing. I mean, we're only literally a couple of points away from the current market price. And if somebody says to you now, what price are you going to make the market on? I would look at that and say, well, at the moment, that's a 1 point spread, right? You might say 2 points. It doesn't make any difference. So you're going to price this at 63 or 64 offered. Does everybody agree? Do you see how your offer's not getting any higher? So even though the candle's higher, the offer stays the same because the volatility is dropping. You might say, are you not worried about the volatility breaking 62s? Yes, absolutely. Absolutely. But I'm also very mindful of the fact that R squared is incredibly short. I want to be short this market, guys. I want to be short gilts. Absolutely. So 64 stays. 64 is the offer. Take a look at what happens. I'm still not getting filled at 64s. I've got a little turn up in value, but I've still got a lot of value in this deal. 64 stays. 64 stays. Let's see what happens. And now you can see what starts to happen. I don't get filled at 64. I don't want to get filled at 64. I'm mindful of the volatilities that are coming in here. I'm mindful of this pin rejection. So I'm going to be more inclined to be interested in this if it starts to move out. In other words, I didn't get filled at 64. I don't want to get filled at 64. You might be saying, how do we, what about this candle here? Could we not have maybe got short in this candle? Well, we don't know because it closed at the highs. So we'd have to have seen it in real time, guys. We can only look at it about what we can see. If I'm looking at that, I would definitely have looked at that as a possible sell around about 61s. I might have looked at it as a sell at 60s. But on the basis that you don't get filled at 64, you're definitely going to now be looking to get filled around about 61s or 60s and a very, very nice 10-point move on the gilts. Very, very nice indeed. And judging by the look of it, it looks as if there's no reason why this can't be trading 40s. No reason why that trade can't now be trading 40s. Okay, it's the UK gilt market. What's your market? Starting to get into the habit now? At the moment, I'm looking at this and saying, okay, no idea. I've got a very bullish R squared and I've got a very bearish R squared. So how would you price this? You need to come up with a two-way price, guys. I would price this at 35.55. 35.55. You might say 55 seems a little bit close. Yeah, okay, 60. Doesn't make any difference. I'm going to be pulling it regardless on either side. At the moment, I'm going to be pulling it on either side. Is that not good news? Is that ability to not get filled on this trade at the moment really, really good news? You're not going to get filled because there's no way 35.65 is going to get filled, right? In other words, you're saying that you think this market's going to be volatile and it's going to break out. And at the moment, you're not sure which direction. It looks like it's going to break south. You may say, could I not offer this? Well, not with the R squared up here. If you want to go for a squeeze trade, you might want to go in for a quick 1 or 2 tick profit. Different trade altogether, perhaps yes. Let's carry on. So you think about what you would price the market, not about what I would price the market. What would you price the market at? And what I'm hoping you're starting to understand and learn is that this is different from what you've been doing so far. Okay, so how are you going to price the market now? It's broken south. The value is dropping. This value is dropping. It's still got a lot of buy side value. This has got a lot of sell side value. So I'm still going to price it 35. Because that started to drop, I'm going to bring in my offer a little bit here to 52.53. So I'm going to go 35, 52.53. In other words, if I'm going to 35, 52.53, you'd imagine the next candle's probably going to be bearish, right? You're probably going to see the price going from 48 to 46, so probably 44. So 35 looks reasonable. Let's see what happens. How are you going to now price this, guys? Oh, well, wait a second. I can hear you all starting to shout already, aren't you? You're already starting to go ball at the screens, or at least you should be. My God, I'm going to start pulling up my 35 bids into 44s, aren't you? This looks fabulous. Look at the size of that R-squared change. Now the macro blue is in our favor. The short-term black line is in our favor massively. I really like the 44, 45s. You'd obviously want 43s, but you can see how your changing stance on this trade is now really driving you into the price. You're not waiting for the price to come to you. You're now driving your bids in. Somebody comes on the phone now for a two-way price. You're going to say 44, 55. 44, 55. 44 bid, 55 offered. If they want to sell, you'll happily take them at 44s now, correct? If they sell, you're happily going bid at 44. So you're going 44, you might even pay 45, and now you see the value of understanding this. What happens next? The price starts to go up and it trades 46. Value's kicking off. The blue line starting to kick off. It's a winning trade. This looks really good. This should be trading at least 50. And because it's trading 46, you're going to be bidding 45, right? You're going to go 45 bid, 58 offered. 45 bid, 58 offered. You're starting to paint the shape of the candlestick that's going to happen next, not the candlestick that's happened. You're starting to paint the candlestick that hasn't yet happened based on volatility and price. What happens next? This is where we did the bidding, guys. You bid 44, you paid 45, 46, the pin came in, you got filled in that trade. That's what happened to the trade. You ended up 65s. You ended up away off the top edge of the screen at 65. Unbelievable, right? Unbelievable that you guys, as interns or as beginning traders or even as professional traders, have the ability to price the market this accurately that allows you to actually interact with the auction the way a professional should. Do you have the ability prior to this classroom to do this? If you did, congratulations. I don't know why you're in the classroom then. I don't know quite, because there's not very much I'm going to be able to add to your knowledge. And then, it's just about you developing out those skills. But if you didn't know this stuff, if you weren't pricing the market and you didn't know how to price the market, can you now accept that this is different from the norm? Can you accept that this is now different from what you've understood? Take a look at this value here. Can you see why the S&P, I was keen to offer 18s and 19s based on the green line value? So I was just basically sat all day offering 18s and 19s on this trade. 18s and 19s, literally the entire morning session here. And what happened? That's what happened. The 18s, 19s offers traded 96. Over $1,000 a contract on that sell trade based on a very easy relative value storyline. Getting involved in the right price, getting involved in the right trades. Let's move on. The same trade. This is a look from a dispersion point of view using RGL and structure. In other words, what color is the market in the background? Red. Where is your R squared? Sell side. How are you going to play this? I'm going to be a seller and a seller only. In other words, you're starting to use your intern tools to start recognizing. Remember, we talked about selling at these prices here and selling at these prices here. Did you ever have any of them that were relatively good value to sell into those blue candles, is what I'm asking? No. In other words, you would have missed out on all of those scratch trades and losing trades, wouldn't you? Instead, you'd have been able to look at this from a interns to intermediates into that pro trade idea that this is a sell market with sell value using a dispersion point of view, but I want to sell this price up here. I want to sell these better prices. And if I can sell into those better prices, understanding the concept of the auction process, I'm going to get a far better price. I'm not going to be selling at bottom edges. I'm still selling inside of the narrative. I'm still selling inside of the red background. And now I'm starting to develop as a professional. I'm now pricing that sell order based on dispersion. I'm pricing the sell order based on volatility. I'm pricing the sell order based on order flow. I'm pricing the sell order based on volumes, even price action. I'm pricing the order flow. I'm pricing the market based on R squared. And because of that, I'm finding the best possible trades, the best possible prices. My execution, which I've been tuning for the last few weeks as an intern, is now coming to the fore as a professional. I'm starting to use that information now to recognize where the best trades are by building into that execution process. It's still a sell trade. Nothing's changed except for your knowledge and your ability to interact properly with the marketplace that we can see here. If you think about the first exercise and then the pricing exercise that the professionals do, and then you start adding that, do you honestly think that you can start to see those sellable opportunities? Just take a look at some of these candles. Look at these candles here. You see the slowdown in the candles. Do you not think one of your offers would have been filled on that trade eventually? And if it hadn't, you'd have been very, very close to getting filled, which means you'd have been very close to actually getting into that short regardless. Do you not think that just with the candle slowing down again here, that you would have been bringing your offer back down again? And because you're bringing your offer down, you're starting to recognize the fact that that's probably going to break, and it's going to break soon. Well, if you believe that this information is going to start helping you do that, can you also therefore agree that that would have been worth over $1,000 on that short sell? That you would never have gone bid during that process? You'd never have gone bid. You'd never get filled on a buy order. As an intern, you can't be filled on a buy order because the market's red. That's the first thing. And secondly, look at the value line narratives. The green line is already telling you there's almost impossible chance of you being a buyer. So therefore, your job was just to get those sell orders on the books. Guys, this is Friday. This isn't cherry picking. This is Friday. We took screenshots knowing we're doing this classroom today so that you could see the kind of things that you would have been looking for, the kind of trades that the intern to pro exercises would have allowed you to find. And if you didn't find them, you would still at least have been able to find the intern's exercises that still eventually caught that $1,000 downside. But you can see you can do so much better than simply a systematic exercise, because the systematic exercise says sell the blue candles. Systematic exercise number 2 is sell the light blue candles. That's a fade exercise. So there's a momentum exercise here that we then give you the rules to make sure that the rule stacks up. And then there's a fade exercise on the light blue candles to fade the light blue candles if the rule stacks up. So if you sell the light blue, sell the dark blue, 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 etc., etc. Sell the light blue, sell the dark blue, sell the light blue, and down she goes. There's a lot of exercises to be done during those flat periods. But how about you just sell these guys? How about you just sell these guys by then pricing the market properly? Well, you get to that stage eventually with the pros exercises. You get to that stage with the pricing exercises. You get to that stage when you become a professional. Not before. You have to get the other exercises, interns to intermediates, before you get to sell these top edges. And as you become a professional, you can, of course, start buying some of these down moves. You start interacting with the down move. Let's carry on. Order fillers. Okay, so now we're going to be talking just about the order filling exercises that you will learn at the beginning of your internship. As you start stepping into the internship for the first day, you are an order filler. End the story. The first things you'll start learning is to fill the orders. The next things you start to learn is to get the best execution for those orders. The final thing you start to learn ultimately is whether you want to take those orders at all and how to take those orders. So when we look at this, this is an order filler's trade, right? Lots of volatility desk buyers this morning for the weekend, which should keep top lines capped. So you're going to be looking at the top line and you're now filling those top lines for the volatility desk guys, right? So when you see that, you're going to be short the market. In other words, you understand what the order is and you fill it. The second phase, you'll start to fill it at the best price. The third phase, you'll decide whether you want to take the deal in the first place. Okay, it's 3 phases. Fill it at the best price, decide whether you want it in the first place. All easy. So there's only the 3 stages, guys. Only 3 stages. Take a look at these phone calls, information, call it what you like. Equities, bids, 340. Okay, so 340. So this is where the information's coming in here on the left-hand side. The bids are starting to drop off now, guys. You may say, but that's not an order. That's not a phone call. Well, come on, guys. What does it mean? The bids are starting to drop off. What candle shape is going to paint? It's going to be a big red sell candle, right? If the bids are starting to drop, in other words, as an intern, your job now is to execute on that information. Your intermediate job is to get best execution on that execution. And your advanced professional is whether you want to take the deal at all. Okay? So your first step is to get the deal done. So the worst case is, as soon as that order comes in, you start saying, well, if the bids are dropping off the bottom edge, I'm going to be selling into the bottom edge. I'm going to be selling into the bottom edge. I'm going to sell the bottom edge. I'm going to sell into the bottom edge. I'm going to be selling into the bottom edge, and so on and so on. Do you think you could have made money as an intern? That's a great start, right? Do you think you could have made money, more money as an intermediate? Absolutely. Could you have made more money as a professional? Perhaps, yeah. So you can start to see the process. The intern has to do the deal. They have to get in. They have to understand what the instruction is. The bids are dropping off the bottom, basically. So I've got to get in for the bottom because the bid is now pulling. If the bid is pulling, I get the trade done. If the bid is pulling, I get the trade done. If the bid is pulling, I get the trade done. As an intermediate, I start looking for those bids pulling. As an intermediate. As an intermediate, I start looking for those bids pulling. And if I see the bids pulling, I start now getting best execution. If I don't see the bids pulling, I wait until I see the bids pulling in line with the instruction. In other words, the instruction tells you what to look for. Bids dropping off is quite clear as far as I'm concerned. Your job as an intern is then to act on that information. Let's carry on. Now, this is coming in from the trade log. Okay, this is now trade log entries. So these are a lot more. There's a lot of phone calls, if you like. Remember the guy on slide number 1? The guy on the phone? Well, this is the phone calls coming in. This is the noise, the information coming to you as an intern. Aggregate supply doesn't mean anything. It just means a market sell side. Well, that's normal. You'd imagine this market would be sell side with the market dropping as fast as it is. So let's see what they're telling us about that supply, right? Let's see what they're telling us. 1829. The market maker is adding bids into discounts below. What's your job as an intern? Add discounts into bids below, correct? 1829. So you start looking at this here and you start saying, well, there's 1828. Market makers are adding bids at discounts below. You start looking at this price here and say, right, 98 is below. Then you start asking, well, how far below, etc., etc. But step 1, you're now going to add discounts below. So you go 98s, I'm going to do, say, 96s. I'm going to buy some 96s. As an intern, you're going to go 96 bids, you're going to go 97 bids. You're now buying below. And you're now watching for a book flip as an intermediate. So as an intermediate, what are you now doing? You're now watching for the book flip. You're not buying as the price drops. As an intermediate, you're now waiting to see the book flip. When you see the book flip, you're now taking advantage of the buy opportunity. And as you take advantage of the buy opportunity, you can see that you then make a lot of money once the book has flipped. What else did we see at the same time? Dealer rotational bids expected to appear at swing lows. That's exactly the same. Dispersion via implied correlations, looking at bidding into the swing lows as well, right? So there seems to be a lot of different trade desks all wanting this low price. So it's starting to form your opinion about it. It's starting to give you a few clues about what could be done. As an intern, you need to get that trade done. And what you learn in the intern part is to get the best execution for that trade. No other trade. You're doing what it says on the tin. You're getting best execution into that trade. And that's what you're looking for. Best execution. The trade itself turns out from a 96 up to a high price of 0.6. It's for $500. That's a pretty good trade for 10 minutes, isn't it? Pretty good trade for 10 minutes. $500, guys. Absolutely fabulous. Friday, 15th of September. Not cherry picking 5 years ago. Let's see what happens. Friday, 15th of September. Future bids versus sell and option volatility rotation for the dispersion desks. Okay, 1924, 1923. Future offers versus a buy rotation on dispersion desks. So you look at 1923 and you look at that and you say, well, they're offering into this. The market's red. See how the market in the background's red? And they're offering it. So you would say, well, I really like the idea of getting short. And then they hit you with a bid. As you start to come into this candle here, they start hitting you with a bid, and you look at the bottom edge, you see how the market's red, you see the volatility, and you go 99s, 97s, 98s. I'm not going to bid this until I see 97s, right? All of a sudden, you start using that volatility, you start using that directionality to avoid bidding too soon. If you saw that there, you might have bid some 98s. That would have been a mistake. You're not taking into account the volatility we did in classroom number 1. You're not taking into account the fact that you're in a sell market. You're not taking into account all the other tools, all the other elements, all the other evidence that that's not a good price to pay for this. So what is a good price? Well, at that stage, 96, 97 would be a good price. And then when you start trading 96, 97, and you start seeing this kind of spinner candle with this big volume, you start to see some R-squared bids coming in. You say, well, now I think this is a good buy trade. Well, that could be part of a professional decision to make a buy at that stage. This could also be part of obviously your intern development into an intermediate to buy at that price. If you bought at that stage there, 97's traded a high price of 0.3, congratulations. You've just made yourself another $300 in another 15 minutes. Same day again, same day. Do you see how you're starting to help form your opinion with these phone calls? These are what we call the phone calls. The guy on page 1 was picking up the phone and he was asking the question, what is your market? What is the market doing today? What are you telling me here? I think you'd be better I think we should offer some 99s. I think we should bid some 97s for you. How do you feel about that trade? Okay, I like your style. You better be right, because I need this filled, but I like your style. See how it's starting to develop? You're starting to give your clients a lot more input as an intern. You're starting to give them a lot more value. You're becoming more valuable to the organization. In other words, you're becoming more valuable to yourself as a retail trader. You're getting better. You're demanding the best prices, the best executions. You're making decisions now. You're seeing what they want to do, and now you're interacting with what they want you to do. This is just a buy trade, and this is just a sell trade, right? That's it. That's the intern's trade. Do them. In other words, if you're in the intern's exercise on day 1 and you see that futures offers at 1923, you will be selling that at 1923 on a demo account. I want to make sure everybody gets that trade on a demo account. If you don't get that trade, you're not an intern. You're going to be out of the door very, very quickly. You need to be able to execute and execute quickly, because what that's going to do for you is it's going to start teaching you. You're going to start learning the good from the bad, the good prices from the bad prices. We'll then start asking you to get the best execution on these trades. You still need to get the trade done, and that's when the real rubber meets the road. Because you might have somebody looks at that sell trade at 1923 and says, actually, the 1923, in all honesty, is this candle here, but it comes down in this candle, right? So at 1923, the price was 45 evens. You might get somebody looking at 45 evens and saying, I think I can get higher at this stage. And they start looking at that and saying, I'm going to offer 0-1s because they want to try and win the intern's game. And they offer 0-1s, and what happens? They don't get filled at 0-1s. Because they don't get filled at 0-1s, they're now waiting at 0-1s, and then the price drops 99s and 98.5. Well, either you're going to get sacked or you're going to have to get 98.5, right? So you end up taking 98.5. What have you just learned? You've learned that you needed to be more aggressive in a red market. You've learned the signals. You've started to ask questions of order flow. The book, the liquidity turned ages ago. What the hell were you still sitting at ones for? You see the difference? You see how professional you're starting to price the markets? Do you see how professional you're starting to approach this as a subject, as an occupation? You see this idea that you would get sacked if you never got that trade on, but if you got a trade at 99, you're probably going to be the bottom of your class. So there's a very, very fine balance. You got to get the deal done, but you got to get it at the best price eventually, and only the cream rises. Now you see how difficult it is to be successful. You've got to get to the top of your class, otherwise you're out. Goldman Sachs only take a couple from perhaps an intake of maybe 50 people. They'll maybe take 4 or 5. The rest, they all go and work for Commerzbank. You know what I mean? So you get this idea that you've got to get as good as possible, but you've still got to get the deals done. Futures bids, 1925. This was 1925 in here. Future bids versus a sell and option dispersion trades, right? 1925, this was 23, 24, 25. So we're getting the bids into this area here, right? So we've obviously got these offers at 23, and then at 25s, we've now got the bids coming in, 23, 24, 25. So you're now bidding. Again, you need to get the deal done as an intern. You need to have that deal done as an intern. And then as an intermediate, if you pass the internship, what you're now going to try and do, of course, is get best execution. It's in a red market. I think I can get an extra tick. I can squeeze an extra tick. I can definitely squeeze an extra tick. Well, if you can't squeeze that extra tick, you better have a strategy in place to make sure you're in it. Because this guy wants their fill, right? This guy on that dispersion desk needs their fill. You leave them without their fill, what happens to your firm? Your firm is in the hole if you don't get the fill for this guy, right? Your firm will have to stand whatever the loss is. And if they have to stand whatever that loss is, guys, you will not be in a job on Monday. You will not be there on Monday. So you've got to get the deal done. Let's carry on. These are all Friday, by the way, guys. You'll see this for yourself. They're all Friday trades, every one of them. 1930. Market makers are now adding bids below NASDAQ. S&P, future bids, 1930. Future bids, NASDAQ. Market makers adding bids. And then at 1928, an HFT buy program. This scrolls from bottom to top. That's why the times go from high to low, okay? So 1928, we've got some buy programs coming in. We've got market makers at the bottom edge at 1930. And you can see here, 1925, 26, 27, we're now looking at market buy programs. Well, a buy program is a momentum buy program. So you better get ready for that momentum buy program. A momentum buy program, simply put the order above the candle high. That's it. And then get ready for those passive bids now. 1930, get those passive bids. 1930, this is it here. There's 1929, 1930 candle right there. Get those passive bids in. You've got to get them bid. You've got to get that trade done. 97 trades a high price of 0.3. There's your 6 points. You can see the number of trade opportunities that was telling you to get that deal done. If you don't get that deal done, guys, you're out the door. Let's crack on. 1935. Here's 1935 on the screens. It's this break higher. S&P expect maximum strong offers from the dispersion guys. So you now know that the dispersion guys are going to go maximum strong offers on this trade. You've got to get the deal done. So there's the sell. It doesn't go very far on this occasion. These guys don't lose very often, but it only goes 4 points. That could, of course, simply be an exit price. It doesn't mean it's an entry. That could be an exit price. It still goes down 4 points, 5 points, 6 points. Still scratch out the trade, but you've got to get the deal done. Tells you there it's a mean reversal, and that dropped back into the mean reversal. Sometimes it's top ticking and bottom ticking the market. Sometimes it's just these individual mean reversals. Worst case scenario, you scratch that trade out and you don't make any money. Boo, fecking who. Move on. Option dispersion hedgers versus implied correlation index. Look for bids into aggregate volume. 1953. There's 1953 candle right there. It's into that aggregate volume. Look at the size of the volume. It's already visible. It's already there. What are you going to do? I'm going to start bidding immediately for this client at 99s, 99 quarters. Agreed? Immediately. Because we've already got that aggregate volume. Your instruction is there. You've got to bid into aggregate volume. It's already on your desk, screaming at you. Get the deal done, in other words. Pay the 99s, pay the quarters. And obviously that trade, $250, it took you about 7 minutes. 7 minutes as an intern to make the client $250. Well, that could be your trade. That could be your money in 7 minutes. Let's see what else we get from the trade log. You can see it's just sequential at the moment. 1957. We get a sell program coming in 1957. Let's find the trade. There it is there. There's 1956-57. We get a sell program coming, and that's a momentum sell. So in other words, you're going to trail the candles in the first step. Trail the candles. And then we start getting future offers in 59-59. If that's the 57, that's the 58. This is your 59. Future offers, 04. Trade 02. 1 minute later, you're up $100. 60 seconds later, you're up $100 on that trigger. And that's as an intern. You might not actually like it as a pro. You might look at it and say, I don't really like this trade, but as an intern, you've made your client your 100. As an intermediate, you've got the best execution on that 100, and you've been able to fine your skills, fine-tune your skills to make sure that your execution really is at the best possible price. Let's carry on. Let's see what happened to that sell trade. Let's see what happened. Outcomes on the next chart. And that sell trade actually went from 4 down to a low price of 98. Pretty good, right? So that little intern sell trade from 4 to 98, 6 points, $300 in under 10 minutes. 2000 hours. The market makers are now adding bids below. Watch for trap shorts to buy into. There's the intern's instruction. 2000 hours. Trap traders below. Well, what do you understand about below? Do you think about the bottom edge at that stage? So trap traders below. Well, now I'm looking at the line. I can draw a line across here and I can say, well, I'm looking at a price around about 98s. And I can look for that trade below, not above. It doesn't say above. It quite clearly says below. So you put in your orders, you look at the orders, you look at the volatility, and your job is to get the deal done. 98s, trades 04s, 6 points, another $300 winning trade. We're making a lot of money on these little trades, aren't we? These are all intern trades. These are all trades that you're getting from your market watch, from your intern's trade log. Eventually, you'll be able to interact with these trades as a professional. As an intern, you do them on demo to learn what they are, to learn how good they are, to learn about the positive expectancy, to learn about execution skills. And eventually, you may start taking some of them or all of them as trades. Eventually, as real trades, as real opportunities. But you've got to get to that stage. You've got to learn the process first. You've got to learn how to price the market first. You've got to learn about volatility. You've got to learn about R squared. You've got to learn about these order flow elements that help to fine tune that entry execution process to make you the best filling broker in the world, competing with the best filling brokers in the world, so that when you become a professional, you can use that skill, that ability to give you the best trades possible. Let's carry on. Oil. Make your call. Couple of oil trades here. If oil was manipulated lower than $90.41, you're looking for a bid. That was at $18.45 on your screens. It never traded below 1990.41, and then at 1900 hours, oil offers expected into liquidity pools at 1900 hours. You can see there's 1900 hours. Look at the big volume starting to come in at 1900 hours, and the price went 90.80s to 90.50s. Okay, so what? It's a $300 profit. Still a $300 profit. Again, make your call. And that's really it, isn't it? It's about making your call. It's about looking at these elements and asking yourself the question, have I got the tools? Have I got the ability? Am I able to make the call? And that's basically it. That's what we've got for you. The idea of being able to make the call. We started out this little webinar with the idea of, do you know how to price a market? We started out this webinar talking about, have you got the abilities to be the guy on the phone here, executing these orders? Have you got the tools to execute orders? Maybe you have. Maybe you've got a very, very good positive expectancy from systematic trading, in which case that execution process is obviously the key to that systematic trade being successful. But if that's still something that's leaving you wondering about, you as a trader, because at the end of the day, whether it's me that gives you the systematic trade or anybody else, or whatever, you're still reliant on that systematic trade giving you the trade. You're still relying on the rule still being valid tomorrow and the day after and the day after that. Now, it may well be. It may go through a period where it has a horrible drawdown and you don't know why, because you don't have the knowledge and the ability to know why it has this drawdown and to stick with the plan. As a professional, you now know why it's maybe had a drawdown. You maybe know why it's not making those volatility expansion trades as well as it used to. Why do I not make the same money? But you've got to start there. At the end of the day, you've got to start somewhere. And starting somewhere is the interns, where you've got to make those trades. You've got to take those structures. You've got to be involved in those deals. The second phase is to get the best execution on those deals, the intermediate phase. And the final phase is when you start interacting with that structure and saying, I don't want anything to do with that deal. I think that deal's rotten. In fact, I might be taking the other side of that deal. It's that bad a deal. And then you start recognizing the games that the market play to get you to do certain deals in the first place. If you've ever traded the London Open, you'll probably know exactly what I'm talking about. The number of times that they'll fake the market to the top side if they want to sell it, and if they'll fake it to the bottom side if they want to buy it, is legendary across the world's trading floors. You start to pick up on these clues, these ideas, these thoughts, and you start being able to interact with these auctions properly. Not because as a systematic trader it tells you to do it, but because as a professional trader, you want to do it. The systematic trader's just giving you that idea that at least you'd need to be in that trade, if not before, if that's how you're going to deal. So when we talk about intern to pro, we really do mean it. We'll give a number of ways of simply getting involved in the intern's process, taking those deals, learning the positive expectancy, learning how to then start interacting with that as an order filler who now has execution, a little bit of wiggle room on that execution, and then start developing the tools and the knowledge and the abilities around this relative value, this R squared matrix. Learning what we call the EXE trades, learning what we call the matrix trades. They're all very straightforward things where you can build your own phone calls, your own trade log if you like. But we've also got the trade log. The trade log gives you this constant feed coming onto your screen, looking at the constant feed, telling you about the phone call that's coming through. As an intern, you follow the phone call. As a intern on demo account, remember guys, because you're learning this process, not real. And as we get into the process of getting best execution on demo, you start to fine tune that execution. And as you learn that process and you learn about expectancy, you start to see whether you want to take these deals or not. And as you start to improve, then it becomes dead easy. All you do is you go back through the 3 exercises. I definitely want the deal. I definitely want the best price. And you've got the tools to do that. I hope we've shown you enough so far from the trade log today about that was all Friday's trade log, by the way, guys. All of it was Friday's trade log. Nothing chopped in, nothing chopped out. We're just looking at individual trades, things that you could see. We also looked at the NASDAQ where it made over $10,000 per contract in total. Okay, so there was 2 contracts eventually, but $10,000 in total over the 2 contracts over the course of the day on 1 trade each, doing the interns exercise number 1, the RGLs. And then the idea of then having the ability to interact with those RGLs with the trade log, with other RGLs that we can now develop called the X's, and obviously all the other trades that we develop in between. There's a lot of stuff in it. I think that's why Kim decided to push it out to a full 100 days. It's not 100 solid days, of course. It's 100 days of just getting to know this stuff, being exposed to it every day, understanding the exercises, going through the first exercise all the way through to the pro exercise, getting you up to speed as quickly as possible, but leaving nothing out in the process. I hope you decide to join us. I hope there was something of interest. And if there wasn't, I hope that worst case scenario, you go away today thinking about this idea of pricing the markets. If you decide not to join us, then on Monday, think about how you're pricing the market on the right-hand edge. If you suddenly find that you don't have a clue what you're doing again because you can't price the market because you don't know what to price it against, if you don't know how to price it, then you know where to come. We're waiting here for you. We're waiting to welcome you in to start showing you these things. If you know how to price it, then I'm sure this little classroom exercise hopefully has shown you a few extra ways you can start considering this in terms of that volatility and in terms of that underlying flow of structure. Have a good one. I'll see everybody on Monday that's with us. And until then, I'm going to say, meantime, adios amigos, arrivederci. Auf Wiedersehen, sayonara, tutsins, tak skredo, dos vidania, and spasibo, guys. Ciao for now.
Thank you so much, Ray. That was excellent. I agree, John. It was a really great lesson. And thank you, Austin. In fact, I'm going to be sharing your story. I did share that with Ray as well. Thank you for sharing your journey with us. And proud of you. You've been working hard. And as Ray's getting out of here, it's very late for him. I know this was kind of a last minute thing. I said, come on, let's get in here. I need you. I felt like over the last couple ones we're not really laying out exactly what we're trying to do, but I am so excited for the guys coming in. I think we've got a great format of giving you guys some real structure on these lessons so that you guys can see this. I'm gonna real quick go ahead and share the screen. How was everyone? Did you guys enjoy that? Did you get some ahas? I saw you guys posting that you had some ahas, which is a good thing. Let's see here. Some reason it's not wanting to sign you up. You can't wait. I hope so. Nice work. Nice work. Let me see here. I am trying to get this here for you guys. It's not wanting to let me do it. We'll get it figured out here somehow. Let's see. I think now it's possibly going to let me do it. There we go. And the intermediate phase gives tremendous edge. It really does. But the intern part, when you're just getting going in there, as Ray was showing that on Friday, I was so, it got me really excited. That's why I said, Ray, can we please do a follow up? Because I want people to know coming in, yes, they're going to be learning at an institutional level, but we can have a quick start to get them going. So that's why I thought, 100 days. And Ray had mentioned this a while back. It's the reality of experience. It's really getting in there, having a deep dive, and why it's so important because we're in the room each and every day. We've got our trade sessions, and now with Ray integrating the trade log to, so you guys can see those phone calls, but not even just see them. I mean, not hear them, you'll be able to see them. And I think that's going to really help. And so, we'll be taking this through the intern part of building out, getting you a foundation, a base to get started, integrating everything. And then at the end, you having a blueprint of you knowing what the right fit trades are for you, and you being able to go, like Austin had shared in his message to me, the BSG, the before she goes, has really, and with the value, has been able to really become his go-to trade. And once you get that, you kind of know that's your trade. So that's what we're going to be working to help you with. Really, when you step back and you think about what Ray was talking about, it's just a game of statistical probabilities, and you want to be getting better every day. So that's what the 100 days, kind of, I picked 100 days because I thought our goal is to have you each day looking to try to do 1% better. Does that mean you're going to be 100% winning trader at the end? No, what it means is you're going to have a blueprint to be building from, and you're going to feel so much better from where you were when you started. You'll have a lot more information, to get you going. And here's Austin's trade journey. He had sent this over to show, what his stats were. And I thought the cool part was, just like when Ray was showing, he made the majority of these trades with using one contract. And, his point was if he'd used five, it'd have been 5,000 for the week. But he was very happy. He's, I'm going to read his, little message that he had given, but he's only $500 away from passing his challenge. And I think what was important is, like he was saying, not sure when it clicked, but BSGs and value line divergences are his bread and butter now, just looking for sharper entries to have even less drawdown. He's not the emotional type, but he had tears in his eyes because he's been pursuing this dream for over 10 years. So I think many of you in here can really relate where Austin is. And, I was just really wanting to celebrate him. I send out the message saying, nice work, nice job, because you guys put in a lot of time, you spend a lot of money, there's a lot of thinking you get it and then it's not, and it's forward and it's back. And so what I had asked Ray, I said, let's really take this back, give people, a base, a structure so that they can feel those wins and get going. So I appreciated him sharing this because he also said he was mad that he was brainwashed by all the trash before finding us. So thank you for that, Austin. I do appreciate that. There's, like Ray said, there's a lot of good stuff out there. Sometimes it's just because you don't have enough knowledge to know when you need to shift. I always say Ray provides the why, not just the how, but the why. And I think the why gives you that, um, you know, the how is at that intern stage, but getting just enough understanding the why to it keeps you from getting in a trade and then it instantly going against you. You've got your checklist, and then today it works and tomorrow it doesn't, but you don't know why. But just think about getting, the trade log, the training, spending time live in the markets, being able to put more context to it, where that's going to take your trading. And as with Austin, he feels like he's finally really, made it there. And he just really wanted to share because he felt like this has had such an impact for him and he feels like it can have for others. And as he was saying, he was pleased because this curve is even before mastering order flow. And I always say, get your structure right. And that's where Ray's going to be putting you, is at that base structure so that you can start getting that. Then order flow starts giving you that more pristine prices, but Ray's going to have you live in the markets, on demo, but getting better and better at your execution. So I think that's going to be something different that we haven't done before. And with what Austin's saying, even without having that, he's mastering each step. He's at a 70% win rate. He feels like at once he gets the order flow down, that's going to increase his probability to over 85%. So super happy for you. I thank you so much for sharing. And as you can see, I agree with you, John. This is a really nice curve, isn't it? He's building it, with a really solid plan in place. But we are going to be starting our institutional boot camp. We'd love to have you come join us. You'll be in the room with us live and then we have our daily classes. Plus, you have access to a number of sessions that we have so you can really build out your process. But Ray's going to want to have you in there working on this stuff. We also have a number of amazing resources that for you guys to use. Order flow tools, what you saw on the screen there on TradingView from Ray when he was saying, look, if it's red, you can't take anything but a short position. What he didn't have on there is the aggregate volume, which I love as well. But those, keep you on the right side. So you have those two tools, and you'll have the trade log, which will be integrating more and more into the room. Traders have really enjoyed it. Ray's been doing some, preview classes, getting people, confident in what they're seeing. And then they'll have access to it on a full-time basis. But right now we're in the learning phase. So that's going to be good with that. Like I said, you do have a quick start series. You've got the library of masterclass sessions. You've got the, for Ninja or Sierra charts, you've got order flow. And then on TradingView, you'll have the big board RGL sentiment with aggregate volume. I love this tool. It's so good, especially for you guys coming in. It's such a nice visual aid of just which side of the market you want to be on. So there you go. You get all the resources, live daily, a trade room, your mastery, class sessions, intern to pro. You've got your scalping order flow secrets. You've got blueprints. You'll have access to be able to really understand and integrate the new institutional trade log. You've got your resources and a really good self-help group. So I think that helps get you going, and it costs $19.97. So there you go on that. Someone said, hey, you don't ever say what the price is. It's $19.97 for the 100-day. If you're coming in early, you do get an extra month for getting integrated and getting going. So I do think it's important. I love this, it is. The secret to getting ahead is getting started. And I think it's so hard for some of you guys. I know people have taken so many classes, so many programs, and it starts and setbacks. But I think what you're going to find being in with Ray, what makes it so different is being able to have the live trading sessions and the classes, because there's so much more context than the following days. As Ray's saying, guys, we just covered this yesterday. You're seeing it here in the markets. Being able to draw that out and ask the questions and being able to be on the right hand edge really makes an important, it's a valuable lesson. So that's our goal, is to, help you, have a plan to get better, 1% better every single day, so that you're, kind of know what your plan is. I work with a lot of guys. If you reach out and say, hey, this is where I am, this is what I need, can you help me make my blueprint? We do that as well. We want your success is our success. So that's, Ray has one mission. It's your trading, and he works hard on it every day. I think the one thing that I didn't have in there that um, that Austin had said, to please let Ray know that, all the time that he spends, traders really are doing the work, and how much he appreciated that. And we do appreciate Ray spends a lot of time. It's kind of amazing. I don't know anybody else out in this industry that's, coming in during London and putting their charts up, providing commentary as their schedule permits. We have our US trade session for a few hours. We have a daily class. And then at times we have special classes afternoons, to walk through extra things if he feels traders need it. So there's going to be, this is intensive. You're going to be, it's going to be different, but to do different, you have to, if you want things to be different, you have to do different. And that's what Ray provides for you guys. So love to answer any questions. We'd love to have you come join us. I think it's going to be fantastic. Love to be putting your story up there next. Thank you, Austin, so much for sharing yours. I think that was great. I'm going to stop the recording so I can just answer questions. Hopefully that will help you guys. But do come join us. It's going to be great.